The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The fear of missing out flips to the fear of getting out as the stock market sector rotation continues. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katy Greifeld. We're kicking you off to the closing bell here in the U.S. A lot of churn today. Take a look at the S&P 500, now down about 0.3%. We'll see what happens over the past or the next hour until the closing bells. But the S&P 500 really clawing back a lot of the losses that we saw today. At one point down by 2.3% after President Donald Trump said that Iran had downed a U.S. helicopter. But you can see that we're coming back here. And that goes for all different areas of this equity market. The NASDAQ 100, that's been your loss leader on the day, now down by 1.4%. Chips, where a lot of the pain was felt. The Philadelphia Semiconductor now down only about 3%. And I only say only because at one point it was down nearly 9% a few hours ago. And the Russell 2000 actually managing to make it back into the green, Romaine. The Russell 2000 higher by 0.4%.
Yeah, stocks overall trying to claw back some of those losses. We should point out that tech as a group still at the bottom of the sector stack today as investors continue this under the surface churn from one corner of the market to the next. Today's beneficiary, real estate, as well as some of the materials and consumer staples companies, though historically high valuations and slower momentum, likely to limit the extent of that rotation trade out of tech. Now, that doesn't mean that tech overall is being shunned. SanDisk, Meta, maybe a few other names trying to do what Apple, Nvidia, and Microsoft can't today. And that actually might be healthy. JP Morgan Asset Management's Jack Caffrey sees stocks actually having some further room to run as corporate earnings growth underpins sentiment, despite some signals suggesting equities may have risen just a bit too far.
Not a lot to be worried about here. There are still legs to the story. Will we have bounces along the way? Will we have some setbacks? Will we find something new like, oh, I hadn't thought about that? Inevitably. And I think that lends it to a situation where the pullbacks will be short, but they will be sharp.
Now, here comes the other hand. Citigroup strategists, they are pointing to a few yellow flags out there, notably the fact that traders are actually aggressively building short positions in U.S. stocks. They say that despite some de-risking, NASDAQ bullish positioning remains extended with most longs still in profit. But that keeps the downside risk skewed to where any disappointment could trigger meaningful long liquidation given that still elevated profitability in those crowded long exposures.
Well, let's talk about one of those potential sources for disappointment, and that could come from the Fed policy side. A really interesting chart behind me here. You have the U.S. two-year Treasury yield in white, and then you have the Fed funds effective rate here in blue. If you take back a look back at the hiking cycle that we saw in 2022 into 2023, it was the two-year yield that really led the movement here. You could see that the two-year yield started rising before we actually saw the Fed begin hiking, and that was the dynamic that took us through that hiking cycle. And then take a look at where we are right now. Two-year Treasury yields trading above 4.1%, flipping back above the effective Fed funds rate. And this comes at a time where there's a lot of questions over what the Fed is going to do with this economy, what the new Fed chair, Kevin Warsh, is going to be able to deliver. And the market right now seems to be flirting with the possibility that the next move from the central bank, Romaine, could actually be a hike.
Absolutely, and you see the moves in the equity market. Maybe the story would have been different if what we're talking about with the Fed and interest rates came a little bit earlier here in this bull market cycle. Nevertheless, here we are. Baylor Lancaster-Samuel joins us here in Studio 2, Senior Vice President and Chief Investment Officer with Amerant Investments. Baylor, great to see you here.
Good to see you, Romaine.
I do want to kind of talk about where we are in the equity cycle right now, particularly against this backdrop where macro interest rates in the Fed are starting to kind of dominate a little bit more of the conversation. There's been sort of this rotation within equities now for the last few weeks. And I am curious if there's sort of any evidence that maybe people have finally said, okay, we've made some great profits over these last 3.5, 4 years. Maybe it's finally time to take those chips off the table and move them to somewhere safer.
That's a great question, Romaine. Thanks. I would say that, as you mentioned, we have seen that the equity markets have been doing very well for the last 3.5 years. If you invested in the S&P in 2022, you've doubled your money. As we know, in many single name stocks, you've done much better than that even. So we always talk about the fear of missing out, FOMO, and I would say what I'm seeing right now with the clients is fear of getting out, or FOGO, which means you've already had a lot of gains and you're sort of realistic that you might not have that many more gains to go in this cycle, but you don't really want to take any chips off the table. So we're really not seeing that yet, where clients are making those rotations. I
am curious, though, about sort of the interplay that if money does start to come out of equities, does it by default go into treasuries? Does it by default go into high-grade corporate debt?
Well, one thing we like to look at is the free cash flow yield compared to the treasury yield. And right now what we're seeing is that the free cash flow yield on a forward basis is about 3%, whereas in a 10-year treasury you get 4.5%. So normally you would expect that equities would have a higher yield than treasuries. So we do think that that argues for the relative value of fixed income here.
It's interesting, you bring up the 10-year yield as sort of a starting point, but it seems like investors at large are really hesitant to step outside of the very front end of the curve. I keep hearing calls for the belly. I keep hearing calls, too, to maybe just take a look at money market funds, especially if we're not in a rate cutting cycle for the Federal Reserve. I mean, how are you thinking about duration and where exactly the sweet spot is?
That's a great question. One thing I would say is I'm not that afraid of duration. We encourage our clients to buy and hold a lot of their bonds. And so if you can lock in a 6% yield, which is what we're getting right now in IG credit, we think that's a good enough, attractive enough yield that most of our clients are happy with that. So we're okay with duration here. One more thing I'll add to that is that we don't exactly know what the new Fed chair will say next week. But my instinct is that we can fade this hike a little bit. I think this Fed wants to keep rates where they are, and they'll find reasons to do so.
Yeah, just over a week to go until that debut Fed meeting for the new Fed chair here. I want to talk a little bit more about...
Is that going to get higher ratings than the Knicks Spurs last night?
Wouldn't it be amazing if it did? It'd have to be something pretty amazing to happen there. But let's talk a little bit more about corporate credit, because you mentioned IG. How are you sizing up the relative attractiveness, what you're getting in blue chip bonds versus high yield as an asset class?
Yeah, I think it's okay to lock in duration for the clients that have a little bit less risk tolerance, but actually high yield is interesting as well. If you are afraid about the long end exploding, high yield is a shorter duration asset class. You get that carry. And right now we would say carry is king. So we don't necessarily think you're going to get a lot of capital appreciation on your bond portfolios, but you can carry them. And with the economy in a solid spot, we shouldn't worry too much about credit here.
We'd be remiss in not asking you about what is supposed to be a relatively big data point tomorrow morning, and that is the update on CPI. Most people expect it, at least based on our economist surveys, to be at least on a headline number back above 4%. I guess my question is more so, not necessarily whether it's transitory, but whether this idea that with inflation still pegged well above the 2% target, whether you're talking about core CPI or the core PCE or headline numbers, whether that changes the dynamics of what people are willing to invest in if they're getting this idea, this sense here that the Fed either isn't willing or isn't capable of bringing that number down.
Yeah. Well, that's two different questions. One isn't willing or isn't capable. Yeah. I think they are definitely capable of doing it. And if they want to, they can. I think it's a question of, like you said, what is transitory? We haven't had core PCE below 2% in over 5 years. So that would challenge, I think, almost anyone's definition of transitory. And I also think we're going to start hearing a lot more about a concept called the trim mean inflation number, which is something where they kick out the highest movers and the lowest movers, and they get sort of a middle ground inflation number. That Fed Chair Warsh has said that that's some number that he thinks is important. And if you look at the most recent Dallas trim mean inflation, it's 2.3%. So if you sort of squint your glasses a little bit, you might see 2% on that number. And so I think that they'll hang their hats on a number that looks closer to that 2% target.
All right. Well, it'll be interesting to see whether the market buys it and, more importantly, the consumer. Baylor, great to have you here. Baylor Lancaster-Samuel, Senior Vice President, Chief Investment Officer with Amerant Investments, kicking us off to the close. Here, not only on a day, but a week that is going to be dominated by IPO and M&A talk. We're going to take a little deeper dive into that space with two of the biggest deal makers on Wall Street, Michal Katz over at Mizuho and Naveen Nataraj over at Evercore. That's coming up next here on The Close, right here on Bloomberg. All right, OpenAI has become the third major AI company to confidentially file for a public listing here in the U.S., joining rivals Anthropic and SpaceX in what is now an IPO pipeline worth at least $3.6 trillion. That pipeline, it was a huge part of the discussion today at the Mizuho Tech Conference in downtown Manhattan. I had a chance to sit down with Michal Katz, the head of investment and corporate banking over at Mizuho Americas. Here's part of that conversation.
Look, over the last couple of years, we have seen that scale matters. But in essence, scale has always mattered. But M&A transactions have been larger, LBOs have been larger, and IPOs have been of scale because economies of scale, branding, presence, what have you. I do think that there's a great opportunity to repopulate the public market. The number of publicly traded companies have halved over the last 3 decades, and the public markets have always served as a great platform and is a great vehicle, not just to elevate brand, but also to provide acquisition currency and monetization for our employees. Look, what I do think will open the IPO market is having some successful stories go out there. And so having some of those larger players come into the market, having a great outcome for that asset class should help seed that next generation. I will tell you, Romain, that there is no lack of quality companies sitting on the sidelines that for the last several years have been sitting there developing, maturing their business models, have seasoned management teams in place, and are very much looking for a market that will accept the debut.
And final question, and this is more on the M&A side. I mean, we know there's a huge list of companies out there sitting in private markets. Some of them can IPO, some of them can't, not necessarily because they're bad companies, but there's only so much the market can take. Do you see maybe the potential for additional M&A activity beyond what's already been telegraphed?
Look, absolutely. It's never been about the quantum of quality companies out there. I do think that you needed to bridge the bid-ask spread. Some of those captive companies, portfolio companies that you've been talking about, came into, or I should say, were taken private in the 21 timeframe. And the exit multiple for those companies may be different than the entrant multiple. So there's a bit of perhaps a reckoning or a capitulation as to what type of return you want to achieve on your investment, but it is not because of a lack of companies. And candidly, a company that's growing at 5, 10, 15% and generating significant cash flow can be incredibly interesting and accretive as an M&A target that would achieve incremental synergies as part of a broader platform.
Do you think that when we start to get these mega IPOs, though, is that going to sort of close the gap or the perception of that gap, or does it widen it even further?
Look, I think IPOs and M&A create this natural tension because it does create an alternative for a company to either debut into the public market or have an exit with a premium as an M&A target. And so for me, it's not an or, it's an and.
That was Michal Katz, head of investment and corporate banking at Mizuho. We're going to hear a little bit more from some of the CEOs of the major tech companies that were at that conference. But we want to continue here in the banking space about what to expect from the IPO and M&A market up ahead with Naveen Nataraj, co-head of U.S. investment banking at Evercore. Naveen has advised clients on transactions totaling more than $700 billion in value. Great to see you here.
Romain, thank you for having me.
I do want to pick up on something Michal was talking about and kind of the interplay between IPOs, new issuance, and the M&A activity that either is aided by that or hindered by that. And I am curious that once we get SpaceX out of the gate later this week, and presumably at some point within the next few months, we will likely get Anthropic and OpenAI. What is that relationship with other companies that are maybe looking to go public? Does that help them or hurt them?
Great question. I actually think this is a very healthy development for the IPO market. Companies have stayed private for a lot longer than they have historically. The access to capital in the private markets has been quite unlimited. And so I think it's healthy. I mean, SpaceX is a 25-year-old company. And this is the first time a broader investor base will have, both institutional and retail, will have the ability to invest directly in the company. And it also provides liquidity for a lot of investors who've been in it for a long time. So I do think this is healthy. I mean, right now, between the three big IPOs, it's crowded the market. But as soon as these play through the system, there's going to be a fair amount of liquidity that's unlocked that's actually going to support the next wave of IPOs. So I'm actually cautiously optimistic about what's to come.
Do you think that next wave of IPOs is going to be concentrated around AI? I was looking at the pipeline of companies, of potential companies to go public, and it was basically like 80% of them were either AI or AI adjacent.
I mean, AI is certainly the team to invest in, but if you actually kind of pare it back, if you look at the IPO market, there have been 50 IPOs to date this year. There's been a fair amount of activity in biotech. I mean, that market's really going to come back up. There are a lot of industrial private equity-owned companies that have listed and have had very successful IPOs. So I think it is broader than AI, but AI is going to dominate the news cycle, just given how transformative it is.
We want to go back to the point you were making that, once we get through some of these mega IPOs, that there's going to be a lot of liquidity that's unlocked here. And I wonder, how that comes back into the system, how that's recycled back, whether, taking a look at private equity and, some of those big investors, whether it's more likely that those will go into some of the other large, very large private companies, or whether it'll go towards supporting maybe the next generation, the next wave of some of these startups.
Maybe let me set a little bit of context on what's going on broadly in the M&A market, and then also transition to some of the big capital market implications. But M&A is up 25% year to date, compared to last year, which was the second best year on record for M&A. So even before this IPO window has really kind of broken open, there's been a fair amount of activity and capital being deployed. Interestingly, a lot of that has been corporate driven, and private equity has so far taken a bit of a backseat. So I do think there's going to be, as the year progresses, continued activity from corporates and ongoing activity from private equity. With respect to private companies and their ability to attract capital, absolutely. I think there is an incredible amount of new business creation that's happening that's quite exciting. And I think some of the capital that's unlocked from the IPOs will play back into some of these new startups.
And it is pretty amazing to hear you mention that you think about the year-over-year comparison, that we're up pretty healthily from where we were this time last year. And 2025, that was a record-breaking year in its own right. So, what is driving that? Is that the opportunity set that's available? Is that, the regulatory backdrop maybe becoming a little bit friendlier? I imagine it's some combination of a bunch of different factors, but what are the main drivers?
It's a great question, Katy. And if you look at what drives M&A and what deters M&A, confidence drives M&A, volatility deters M&A. And if you were a board looking at an M&A deal today, there's a lot of reason to actually be anxious, whether it's geopolitical risk, tariffs, inflationary pressures, AI disruption, valuations, and the mismatch that Michal was talking about. I think all of these should give people pause, and they are, but I think the confidence that boards have in their management teams to navigate this environment, I don't think it's ever been stronger. Most of these management teams have been hardened through COVID, through tariffs, through AI disruption. And so there's a fair amount of confidence that these management teams can handle this. And candidly, the rate of pace of change, I've never seen anything like this. I've been a banker for 30 years in tech. And what's happening with AI, we've seen a lot of very exciting transitions, whether that was internet, e-commerce, mobile, social, cloud, SaaS. But this trumps everything, right? And as a consequence, I think the need to act, the need to get scale, is a huge driver for M&A, and we're seeing that repeatedly in boardrooms.
Just real quickly, I am curious about, and I know that there are a lot of geopolitical issues and regulatory issues right now out there, but do you see a little bit more opportunity, potential opportunity for cross-border M&A, meaning U.S. companies with non-U.S. company?
We've seen a pretty significant tick up, and there are a lot of different drivers, right? Within Europe, I think there is a real push to kind of secure their critical industries and get scale. So that's driving a lot of M&A, and it's across multiple sectors, whether that's aerospace and defense or financial services. There's a big move there. In Japan, the dynamics are different. It's an aging population. Their core market's shrinking. They have to deploy their capital outside. So you're seeing a lot of outbound Japanese M&A. So it's not one unifying theme, but we're seeing a lot more global and cross-border activity.
Well, Naveen, really great to get some time with you. Appreciate you coming by the studio. That is Naveen Nataraj. He is co-head of U.S. investment banking over at Evercore. Now, coming up, back to these markets, that tech sell-off continuing to drag down the benchmarks. We'll have a full market breakdown coming up next. This is The Close on Bloomberg. Well, we're keeping a close eye on the markets with the S&P 500 well off session lows, but still down about 0.8%, whereas the NASDAQ 100 really dragging things down. Here to break it all down is Bloomberg TV markets correspondent Nora Melinda. And Nora, in some ways, this feels like a continuation of the sell-off that we got on Friday. If you just take Monday out of the picture, I mean, it's chips, it's big tech really leading the losses here.
Same exact thing that we were just seeing on Friday. Of course, yesterday we did see a bit of dip buying action. But on Friday, we saw the NASDAQ 100 seeing its worst day since Liberation Day of last year. We're seeing a resumption of that sell-off today. Not a broad-based sell-off, to be clear. We're seeing tech really taking a beating right now. The NASDAQ 100 earlier down more than 4%.
Yeah.
And if you think about broader market leadership, we know that it's really been sitting in the tech space. So you're seeing a rotation going on right now. That's what I'm hearing from my sources right now.
Have you heard anything about some of the rumors that we're seeing a lot more retail activity in preparation for the SpaceX IPO? The idea that there are a lot of folks that obviously aren't going to have a bite at the apple for the IPO itself, but as soon as it hits the secondary market, there are a lot of people that want to make sure that they have shares there. Any credence to that?
I've been hearing this a lot from my sources, actually, especially as we think about the fact that this is a hot week, right? Everyone's waiting for the SpaceX IPO. People trying to find some money, those that are actually able to get in on the play. Those people are resituating their portfolios, trying to find money so they can actually tap into this IPO. So some of this that I am hearing from sources is maybe a bit of profit taking. Those that think that, you know, maybe tech has gone too far to the moon and we need to come back down to earth. But also some people that are just getting prepared for this massive IPO that we're seeing toward the end of the week.
I was getting prepared for it, but then I blew all my money on those seats, floor seats for the Knicks last night.
I'm still preparing for it, but only just to talk about it as I am a journalist. I will say it is an interesting setup heading into the biggest IPO ever. If we do see this sort of weak sentiment continue, what an interesting stage to go public on.
Absolutely. Interesting stage to go public. Sorry, I didn't mean to step on your toes here. Was that for me or for Nora?
I don't know.
Okay,
I'm just
sorry.
so everyone.
Sorry. It's just reflexive, Nora. Ignore me.
For everyone. But, I mean, this is just such an interesting week. But also, people are still digesting the economic data that we got. We did see a stronger than expected jobs report just at the end of last week as well. People also filtering in these geopolitical tensions, the new headlines that we're getting constantly, most recently out of President Donald Trump. So there's a lot of different things at play right now. And of course, when you look at the S&P 500, we know it's heavily concentrated in tech. But if you dig a bit deeper under the hood, about more than 300 names are still in the green.
It's a good point there. That breath actually doesn't look too bad under the surface. Our thanks to Bloomberg TV markets correspondent Nora Melinda. Now, coming up next, Romain went on a field trip today. He had a great conversation with the CEO of IBM. We're going to bring it to you next. This is The Close on Bloomberg.
3:30 p.m. here in New York. This is the countdown to The Close. I'm Romain Bostic.
And I'm Katy Greifeld. And Romain, it's nice to see you. You know, I feel like you had a busy day today. You were transiting all over the city.
Yeah, I went all the way down to the tip of Manhattan, believe it or not, which is quite far away. Mizuho was actually having their big technology conference. And as you can imagine, AI dominated the conversation there.
I could see that.
But there were a lot of big tech CEOs there from Synopsys, Lumentum, FIS, and quite a few others. And a lot of the talk was also, well, obviously about, you know, raising capital and how you finance this, but also kind of what's next. The idea, we've talked a lot about digital AI, if you will. Now everyone's on the physical AI, then biological AI.
Oh, geez.
And then I caught up with the CEO of IBM. He's already looking all the way around the corner at quantum, which isn't AI, but apparently it's something a lot faster. And he's actually committed $10 billion to this effort. He got a $1 billion commitment from the federal government to build this old chip fab up in Albany, New York. Have you been there?
I haven't been there, but certainly it's interesting to see the mix of private and public capital coming in there, and IBM being one of the beneficiaries there.
Absolutely here, and it's basically kind of what has eaten the market, whether it's capital markets or in the tech space itself. I caught up with the CEO of IBM, Arvind Krishna. Here's what he had to say about AI's effect on productivity and his outlook on quantum computing.
I'll give you an example. So you can certainly improve productivity of individuals. We'll call that productivity apps. That's where both economists and CFOs get very concerned. But where's my bottom line on that? Is it leading to less expense or more revenue? Where is that? And that's hard to find. But let me give you a second example, and you'll say, okay, I can see that. We are pretty acquisitive. Anybody who does M&A, you often bring the entity in, and actually normally your profits might decrease for the first year or two until you take all of the cost and get the cost synergy. Using AI tools now, we can probably add 10 points of profit synergy on day one, because the amount of time it used to take to move contracts over, to do all of the sales automation, to do all of the revenue forecasting, all of that now using AI can be shrunk down to literally a few weeks. If you can do that, I can now take that 10%, I'm not saying it's 90%, but 10%, and invest it instead in marketing and R&D and innovation to drive the revenue growth even higher. That's an example of what I mean by use the AI to really fundamentally change how you do business. It's got to become part of your operating model of the company.
Are you taking that medicine yourself internally?
We are. In the last acquisition we did, we actually managed to take out about 60% of the G&A on day one.
What's the message, though, that you have, not only for your partners, but also internally for your own workforce with regards to how this actually not only helps, but maybe the idea that maybe it requires a smaller headcount?
It's not necessarily going to be a smaller headcount. So a lot of people talk about this. So let me give you an example. On college hires, we tripled our hiring in 2026 compared to 2025.
Okay.
For
entry-level positions?
For entry-level positions, tripled. Absolute number, tripled. So you look at me and say, why? Because my belief is if these tools make people who are coming in out of college more productive, quicker, that means we are going to be advantaged by having more capacity to build things at a cheaper cost point, which means we can go get market share. Will the shape of the workforce change? Absolutely. But I think there will be more people in the value-driving functions, be it R&D, be it sales, be it marketing, and the creative activities. And some of what I would call classic back office will decrease because you don't need so much there. So the shape of the workforce changes. Total employment is not decreasing.
I want to talk about security. Obviously, we know the potential opportunities when it comes to AI, quantum, and everything in between. You've invested so far, a commitment of about $5 billion towards something called Project Lightwell. The idea that it gives your partners a little bit more visibility about flaws in that sort of AI chain, if you will, for my sort of uninformed framing of it. But talk about why that's necessary, and more importantly, is $5 billion going to be enough?
It's hard to tell whether any amount is enough here. I think, look, this is like asking why are cyber criminals existing? And the old Willie Sutton joke was, well, I drop banks because that's where the money is. Well, if your money is inside the cyber infrastructure, they're going to come. Our investment in Lightwell, I think a lot of people can point out the problems and point out vulnerabilities. Our investment in Lightwell is actually about fixing them. So we are saying that not just open source that we are good at, but if you have open source and the source code is known, we can use these same tools that are used to find vulnerabilities to also create the fix and give it back to the community. That is really what Lightwell is about. Of course, in order to do that, you need cooperation around where people are finding things, how critical are they, where are they in the critical infrastructure. So that is the whole project. But it's actually about us coming up with an antidote, not just the problem.
This, I can just tell by looking at your face, this is probably an exciting time for you. IBM is obviously a storied company when it comes to computing, and we are clearly at the inflection point of something new, maybe something better. You've gotten a big bump in your stock price, largely because of at least the government backing or at least the government support. Is there a sense here, when we talk about the potential for an acceleration in revenue growth, the widening of profit margins, that is something that is imminent, or is that something still long-term?
Well, depends on what you call long-term. I kind of liken what we're doing on quantum and cyber to where GPUs were in 2015, 2016. And each era of technology tends to go faster. So if I say QPUs plus cyber is going to go fast, I think in the next 2-3 years, we're going to see incredible returns coming from these technologies.
IBM CEO Arvind Krishna there, speaking a little bit earlier at the Mizuho Tech Conference here in New York City. And Katy, in addition to talking about the potential for that acceleration in growth, he also talked a lot about quantum computing and this idea of sort of this quantum advantage, which he said a couple years ago they would actually get to using IBM hardware by the end of this year. And I asked him, now that we're halfway through the year, are we going to get there? And he said, most definitely. Most definitely,
yeah. It feels like quantum, as we were discussing, seems to be being pitched as the next big thing that once you wrap your mind around AI, quantum is what you really need to pay attention to. You have to wonder, though, whether, the enterprise side of things, whether corporate America is ready to make that jump as well.
Well, that is a big question here. We talk about this idea of whether this whole AI build-out is maybe a case of oversupply at a time when a lot of people haven't found out what to do with that supply or how to monetize it.
Yeah, you need a use case, is what I keep hearing.
Yeah.
Well, coming up next, we're going to get a check on the state of the SaaS apocalypse with the CEO of Uniphore. It's an Nvidia-backed business helping enterprises scale AI across their organizations. Very timely conversation. We're going to have it next. This is The Close on Bloomberg. Well, we're honing in on the tech space for our stock of the hour, and one private company entrenched in the AI space that has a unique perspective is Uniphore. It's an open standard business AI platform backed by the likes of Nvidia, AMD, and Snowflake. And I'm pleased to say that joining us live is Umesh Sachdev. He is the CEO and co-founder of Uniphore. Great to have you in studio with us, and just set the scene as to what services Uniphore provides, because as far as I understand it, you help your enterprise clients really sort of build up their own AI agents to help with some of the tasks that they have to do.
Well, it's great to be with both of you. Thank you for having me. That's a good place to start. What Uniphore does for customers is we think of ourselves as an end-to-end data and AI orchestration platform. The architecture of software in the AI era has shifted. Customers need to use their own data, these enterprises, and then prepare that to fine-tune models and ultimately build AI agents. So Uniphore helps these enterprises own their entire AI stack such that they have full control and sovereignty. We serve about 2,500 enterprise customers, several hundred of which are Fortune 500 firms.
So give me a sense, though, because, there's been so much talk about why we need sort of this layer of software companies in this process. And I know there's been a lot of hyperbole about, the SaaS apocalypse and, the end of all these software companies, if you will. But give me a sense as to what Uniphore actually looks like in this sort of new world going forward. And I'm not talking about today in the here and now, but if you're looking 5 years down the road, where do you fit in?
Well, three things. First, if you're a large insurance company or a bank or a telecom business, what differentiates you from your neighbor these days, when everyone has access to the same LLMs, is how each company is able to use their own proprietary data to fine-tune these models. The second thing is, think about every business is unique. There's context. There's somebody who's worked in customer service for 30 years, and they know all the tribal knowledge of the company. Unless AI agents understand that context, they won't be able to drive full automation. So that's the first thing that a platform like Uniphore does, allowing these companies to harness their own data, to fine-tune models, and then look into their context, their historic past, and train AI agents. That's the first thing. The second thing, which is emerging, is tokenomics. It wasn't a topic even about a year ago, but now everyone's worried about we burned through our token budgets this year. And what Uniphore did was a choice that we made 3 years ago. We said, instead of going after frontier large language models, most enterprise use cases will be served by open weights, small language models. So we allow these enterprises to drive token costs down. The final thing we do is sovereignty. Said differently, full control, optionality.
Right.
Nobody wants to be locked into a model, a GPU, a hyperscaler. We give them the optionality.
Well, let's tie together a few of those points, because you mentioned that, the AI agents, they need to understand the context of the company, and then what you were saying about tokenomics. We were having a really interesting conversation a few weeks ago that when it comes especially to agentic AI, for a lot of enterprise, it's not so much FOMO, it's FOMO. It's like this fear of messing up. There's this concern out there that, some of these AI agents are basically going to run wild and make crazy decisions and spend a whole bunch of money in the process. And I wonder, whether you're still seeing that. Have you seen sort of a transition there? Are companies getting more comfortable with the idea of handing off some of these processes to AI agents?
Well, first, the big trend, you hit it very rightly. Uniphore does business across the world. We have customers in US and Europe and Asia. I can tell you, first of all, the big trend is our enterprises in America are about a year, 15 months ahead of the counterparts in Europe and Asia. And the one reason that keeps coming up is Wall Street. Shareholders are putting pressure on boards and CEOs to say, in earnings, we need to hear that story. And that's driving this urgency to move fast. Now, when you move fast, sometimes you break glass. And that's beginning to happen. So the concern that you raise is, how do we put guardrails? How do we put governance? And the one example that I always tell people is these AI agents reason. I have a teenage daughter. She does the right thing all the time, but she wants to reason. Can I do it the short way? Can I do it the right way? AI agents need to do that. But when you run a regulated industry like banking or healthcare, sometimes you want these AI agents to follow a set of rules. And so new technologies such as neurosymbolic agents, new research fields are beginning to help enterprises put guardrails around this.
All right, fascinating conversation. We're up against the clock, so have to leave it there. Great to get some time with you. That is Umesh Sachdev. He is the CEO and co-founder of Uniphore. Now, Coming up next, it's the closing bells. We're going to take you there with Kevin Gordon. He is head of macro research and strategy over at Schwab. This is The Close.
10 minutes away from the closing bell. Romain Bostic here with Katy Greifeld. We had a pretty major, intense sell-off earlier in the session, but we are off the lows of the day with the Russell in the green. Dow Transport's in the green, Katy Greifeld, and the Dow Jones Industrial Average, as we speak now, poking into the green itself.
Yeah, it's a little bit interesting because, you know, when we were really at the depths of the session, we saw that sell-off really take form before we got the headlines from President Donald Trump that the U.S. was going to respond to Iran's actions, downing a U.S. helicopter. But then didn't have a clear reason for why at the open today it was sell everything, and now I don't really have a clear reason for why exactly we're seeing this bounce back.
Yeah, I have a lot of theories. Most of them probably wrong. Okay. But it also gets to this idea, though, too, in all seriousness. We talk about the dip buyers coming back in, and this kind of gets to a conversation we have frequently on The Close. This idea that whatever's going on with geopolitics, rates, AI, whatever, at the end of the day, it all still comes back down to corporate earnings. And until you see a meaningful dent or the risk of a meaningful dent in those earnings, you know, there's a reason to be back in the market. And
I think that might be a reason why we're seeing more of this day-to-day volatility. We are in a little bit of an earnings vacuum. We're very focused on the macro right now, which, you know, is up for interpretation. We got a big CPI print tomorrow, and, you know, also at the whims of geopolitics, which has been pretty on and off as well. Yeah, absolutely. Here, let's get some analysis right here in Studio 2 as we count you down to those closing bells. Just about 8 minutes away. Kevin Gordon, head of macro research and strategy at the Schwab Center for Financial Research, joins us here in Studio 2. And I do want to start off with the bull case, which the bull case, as in most bull runs, is typically about fundamentals. I know we kind of joke how nobody cares about fundamentals, but at the end of the day, most people do. And most people are trying to price out this idea that the corporate earnings growth we've seen over the past few quarters will continue, at least in the short term, for the next couple of quarters.
Yeah, I think it's a good point. And, you know, it sort of, I guess, gets to a point that I've tried to make this entire cycle, you know, maybe geopolitical cycle over the past year and a half, where what the market has continued to show us and what the economic data have continued to show us is that the bottom line risk matters much more than the front page risk, meaning you have all of these headlines around geopolitics, not to be dismissed, but at the end of the day, the market's going to care most about that if it does filter through to corporate earnings, and you so far haven't seen that. And I think actually a day like today, you know, even though there's a ton of volatility associated with some of this de-risking around, you know, areas like big tech and semiconductors, the fact that you do have this outperformance from the Russell 2000 at the expense of the rest of the market, I think is further sort of underpinning and emphasizing that point, because one of the reasons you've seen small cap outperformance so far this year relative to large caps is because the earnings profile for that cohort of the market has turned. So that is an important distinction and differentiator. And I'm curious about that too. And we should point out the S&P down 0.5%, but the S&P equal weight up
0.5%
Yes.
here. So you're really getting that yin-yang there. But I do wonder, does that stick? Because I feel like we've had these types of rotations where people seem to, where the trade sort of broadens out, and then at some point people just decide, I want to be all in on AI and tech again.
Yeah, well, you tend to get these extreme moves where you sort of have all these opposite days. One day the cap-weighted S&P 500 is up, but breadth is negative, vice versa. So you're sort of experiencing that today and yesterday, even to Friday. I mean, it's been a series of reversals every single day. That tends to happen after you get these sort of extreme underperformance periods where, the share of companies or members in an index outperforming that index falls to a low. I mean, we were sort of at that point at the midpoint of last week where for the S&P 500, you had fallen close to 20% on a rolling 3-month basis, 20% of members that were outperforming the index over the past 3 months. When you get to those extremes, which we've only seen lower percentages before in 2024, 2023, 1973, when you get to those extremes, you tend to get these more severe reactions in the index like you've seen both on Friday but also today.
And, okay, so we've had 2 days of severe reactions. You mentioned the extremes that we started to reach last week. I mean, what does that portend about the next few weeks, whether or not what we're seeing when it comes to this sell-off in tech, whether or not that does have more room to run?
Well, I think a lot of it will certainly be dominated by, the macro. Of course, the broader IPO landscape is so much in focus for a sector like tech, and how much, how much that will maybe change the game in terms of investor risk appetite, whether there is some shifting in sort of the tech trade, the traditional tech trade in the S&P 500, if people are de-risking to free up some capital. That's always a question, I think, of any IPO phase. But I think beyond that, making sure to the whole, conversation around fundamentals, making sure that there's still a stability in the U.S. economy and that we continue to get data that reinforce that, even if inflation comes in hot tomorrow or a little bit hotter than expected, if you don't see that risk carry over into the labor market and it doesn't derail this recovery that we've continued to see since last fall, then you probably don't have, as much of a tough time for the equity market. But not to say that you can't get these swings from the largest companies in the index that'll continue to push the market around.
Yeah, and a good reminder that we do have that CPI print coming at 8:30 tomorrow. Certainly the stakes are high after what we got from the NFP report on Friday. And I do wonder...
Is that going to incorporate the price of Knicks tickets in there?
I feel like if you break it down enough that you'll find it in there somewhere.
I'll try to look for it. I'll let you guys. I'll be nitpicking. Yeah.
Ping it to us.
Yeah. Exactly.
It does feel like the Fed is left in this little bit of a stasis, assuming that, the data broadly comes in as expected. It doesn't seem like a central bank that's going to be able to move much in either direction. And I do wonder what that means to bring it back to the small caps. As you mentioned, small caps outperforming large caps year to date. The Russell 2000 higher by about 16% on a total return basis. That compares to 8% for the S&P 500. The bull case that I was told for small caps was that you were going to get some interest rate relief. Now we know that's probably not coming, and still you do have this dynamic. How long can it last?
Well, I think that I sort of look at it 2 ways. The first part of it being, I still think that in terms of small cap fundamentals, everything works with a lag in terms of monetary policy. So they're probably still reacting to some of the rate relief over the past several years when you think about the cutting cycle. Not that it's been perfect in successive fashion, but rates have come down. The Fed has cut rates over the past several years. I think the other aspect of this is that, to me, the bar to hike rates is still a little bit higher than I think the bar to cut rates. Not to say that a rate cut is on the table this year, because I think it's probably safe to say, at least with the current set of data, that's not the case. But I think when you think about the context of a labor market that doesn't look inflationary, and you don't necessarily have significant wage-related inflation pressure that's being generated from a tight labor market, that to me is, I think, what keeps the Fed from totally committing to a rate hike. Of course, that can change if the unemployment rate starts to tick a little bit lower, if you start to see wage growth maybe stabilize. But the fact that that's sort of the biggest missing component from the inflation backdrop, I still think that keeps the bar to at least commit to a rate hiking cycle relatively high.
All right. Well, we are going to get a little bit more insight both tomorrow with that CPI report and, of course, next week with Kevin Warsh's first Fed meeting. Kevin Gordon here in Studio 2, counting us down to the closing bells, head of macro research and strategy over at the Schwab Financial Research. And we talk about a market that is well off the lows of the day. But looking at the complexion and you look at what's leading the charge, it's, J.M. Smucker and Pool Corp. Not exactly the type of names you want leading, but maybe that's a good thing.
It does speak to that broadening out that we are seeing, that rotation trade that is still underway today.
A lot of green on the screen, a lot of red too. A full breakdown of all of today's market action starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostic here with Katy Greifeld, taking you through to that closing bell. It's a global simulcast. Carol Massar joins us in the radio studio. Tim Stenovec is off today. Emily Grafeo in his place. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube. Another volatile day in U.S. equity markets, Carol Massar, with stocks at one point in the session taking a huge plunge lower, but clawing back some of those losses into the close.
Yeah, a sensitivity, right, in terms of maybe some of the stories that cross and the headlines out there. Having said that, despite a lower trade on the S&P 500 overall, the index average, you go inside, Emily keeps pointing this out, you've got more than 370 names to the upside. So investors are still out there buying.
Yeah, investors mostly today buying those consumer staples, Home Depot, J&J. Those were really the companies leading the indexes, and the Dow as well. We'll talk about the Dow for a second. It was in the green.
Well, that's good. Again, a price-weighted index, so
You're going to make Katy angry.
only so much to glean there. It is an interesting exercise in index math, though, because even though you do have more gainers than losers, you are seeing some strong buying in certain pockets of this market. The fact that you have big tech and the chip makers really taking it on the chin, you're not going to be able to get that broad-based gain at the index level. The S&P 500, it's off its session lows, but still looks like it's going to finish up in the red here.
Absolutely. Here, and we talk about some of the big gainers on the day. A lot of them, of course, not the kinds that can really move the market. Names like JM Smucker and Pool Corp. Though I do want to point out that FedEx Freight now on a 4-day run. Nevertheless, we get the closing bells in New York, and it is going to be a red for the benchmark S&P 500. At one point, it was down more than 1% on the day. It's going to close lower by just about 20 points, or roughly about 1/4 of a percentage point or so. The Dow Jones Industrial Average is going to finish in the green, higher by about 0.2%. And we should point out that so too is the Dow Transports, up about 1.3%. The NASDAQ Composite and NASDAQ 100 each down by about 1% on the day, and the Russell 2000 posting a gain of about 12 points, or 0.4%.
All right, so squeezing out a gain there. Hey, going back to the S&P 500, as we said earlier, 371 names, Katy, to the upside within that index, 131 to the downside, one unchanged.
Similar dynamic when you take a look at the sector breakdown. I think the circle is particularly interesting today, as you can see, because big tech, that is the big slice of red on your screen, falling about 1.8% as a sector, and that's really responsible for the loss that we saw today. Energy down too as well, but a much smaller constituent of just the sector makeup. In terms of what actually led us higher today, some of the sectors that got us there: real estate higher by 2% as a sector, materials, healthcare, industrials. Overall, 9 sectors in the green, Carol, 2 in the red.
All right, guys, so let's get to some of the individual gainers. We keep talking about these consumer staples stocks. SJM, JM Smucker.
Yeah, Uncrustables.
I find
Jam.
I have one this morning, actually.
Did you really?
Yeah, I love Uncrustables.
It's for the little one. Having said that, this one is your number one gainer in the S&P 500, so it's up almost 11% here in the session. And you did see the company's organic sales and adjusted EPS beat expectations for the fourth quarter. The company also said it expects the board to maintain the current dividend policy, which is to return approximately 40 to 45% of its annual adjusted, sorry, I got stuff popping up on my screen. Kind of hate when that happens. To maintain the current dividend policy, so returning 40 to 45% of its annual adjusted earnings per share to shareholders, reflecting dividend growth consistent with future earnings. It also plans to lower some coffee prices next year as the cost comes down. So Yahoo on that one. The company expecting net sales to decline next year between 3 and 4% when it reduces those prices as it passes through lower costs on green coffee to consumers. So thank you so much, JM Smucker, for that one. Hey, let's go on to some M&A activity today. We're talking about Nuvalent, that ticker NUVL. That one certainly soaring in today's session, up almost 40% in the trade. This is after GSK agreed to buy the company for $10.6 billion. So they're basically getting a U.S. biotech company that's developing treatments for lung cancer as part of GSK's efforts to rebuild its oncology franchise. So GSK paying $124 a share for Nuvalent. That's a 40% premium over the the company's closing share on Monday. So pretty much investors bidding up the stock price makes sense to that 40% premium. So we're just kind of keeping a watch on that. We do see that some of the big tech, not big tech, but big pharmaceutical, picking up some of those biotech names to build out their pipeline. And then I think this was, did Tim talk about this one yesterday? Mission Produce. That went up more than 7% in today's session, rallying the most in 18 months. It's an avocado supplier, and it said fruit supply has normalized and per unit margins are recovering after an unusually high avocado supply environment during the second quarter. And the company also reported revenue for the second quarter that exceeded expectations. So hoo-ha when it comes to avocado. It is a small market cap company, just under $1 billion.
All right, Carol, do you want some chips?
I do.
With your avocado?
Nicely done.
We're talking about the chip trade, but not tortilla chips. We're talking about semiconductors. Big sell-off in tech names today. We actually saw a little bit of a rebound, at least in Nvidia. The stock was down as much as 4.5% today, but it did pair those losses, still finishing the day in the red. Just part of a broader sell-off for the tech-heavy names here. The NASDAQ 100 down, and this was the second time counting Friday that we've seen a big tech sell-off here, with chip makers leading the decline. Another chip maker that fell was Marvell Technology. This is another semiconductor name. It's been a wild ride for this stock. It was actually up 9.6% yesterday as investors got excited that it's going to be joining the S&P 500. Today, though, it's sold off, perhaps on some profit taking after that rally yesterday, and then also just on that broader trade of investors exiting chip stocks today. And then finally, SailPoint. This is another tech name, but this is a software company. They reported earnings showing stronger than expected revenue. The full year forecast was raised on key metrics, but overall may not have been robust enough to extend recent strength in the stock. This stock is up nearly 70% off an April low, but it's down about 7.6% today.
All right, let's take a quick look at yields. They were actually down, and it kind of gets to the big back and forth that we continue to see in all the cross-asset markets here. Basically about 3 to 4 basis points across the curve, and a lot of that, of course, Katy, was tied to the drop that we saw today in crude prices, down basically about 3% for both WTI and Brent crude. Brent crude settling just below $92 a barrel.
Well, I do have some breaking news in the form of Cracker Barrel earnings crossing the wire right now. Cracker Barrel boosting its full-year revenue forecast, beating estimates here. They see full-year revenue between $3.27 billion to $3.3 billion. The estimate had been for $3.24 billion to $3.27 billion. So a beat there. Third quarter adjusted EPS coming in at 29 cents. There had been an estimated loss per share of 47 cents. So a lot of good news here for Cracker Barrel, and you can see that reflected in shares right now, moving solidly higher after hours. Cracker Barrel has been through a lot when it comes to their share performance. Remember, they had that big logo controversy last summer, but for 2026, making a little bit of a comeback.
Yeah, interesting, too, to see some of the commentary here about the relative strength of the consumer. And we'll be interested to see whether what we get out of these restaurant companies is a broader read on the state of things. I do want to just point out, too, as we were talking about that, the city CFO speaking at a conference, also saying that the U.S. economy and consumers have shown resilience. All right, well, speaking of resilience, can we talk about the Knicks? I assume the reason why Tim Stenovic's not here is he's nursing himself in a non-alcoholic beer this morning because of the loss last night. But somebody's not losing, and that is actually the owner of the New York Knicks, Jim Dolan. And I'm just going to read the headline. This is not my opinion, but it says, Knicks boost fortune of New York City's most hated owner by $450 million. It's no secret. A lot of people have issues with Jim Dolan, but the stock of Madison Square Garden sports up more than 40% on a year-to-date basis, partly because of the Knicks winning streak, but also the idea, too, there's been a lot of talk that he might actually going to separate these out into two separate companies. Remember, MSGS owns both the Knicks and the Rangers. The idea is he wants the Knicks to be their own separate stock, and the Rangers, the New York Rangers, the hockey team, will be their own as well.
There's something in this story for everyone. The Knicks, of course, the performance there, the potential for a potential, spin-off. We know that has been hot when it comes to the stock performance.
If there's any year to do it, isn't this it?
This is
Strike
it.
By the iron's
and Dolan himself, you mentioned $450 million added to his net worth.
You know how many hats he can buy with that?
His net worth is now $1.9 billion, according to the Billionaires Index of Bloomberg. So So there you go. A lot of hats for Jim Dolan.
All right. Good stuff. Good year for him, right?
Yeah.
And we'll see what
Emily,
happens.
do you have any thoughts on this?
On how many hats?
Are you a
could
Knicks
buy-
fan? Did you watch the game?
Totally. I did watch the game.
Okay.
Yes.
I went to bed at halftime.
Where were you? How many seats over from Derek Jeter were you?
Yeah, just like 6 seats over.
Yeah, whatever.
All right, guys, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We do call it The Close. Katy and Romain continuing there on Bloomberg Television, and Emily and I back here on Bloomberg Business Week Daily on Bloomberg Radio. We'll see you again, same time, same place tomorrow.
And when we come back here on The Close, we are going to take a deeper dive into the market action today. Another volatile session and a lot of questions about exactly what people are trying to buy and sell. Katy Kaminski, Chief Research Strategist at AlphaSimplex Group, joins us in just a second, right here on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katy Greifeld.
And I'm Romain Bostic. Another volatile day on Wall Street. It could have been a lot worse. You had the S&P at one point flirting with the 2% drop, the NASDAQ floating with 3% drop. Believe it or not, at one point, the Philadelphia Semiconductor Index was down 9%. But as you can see on the board behind me, clawing back a lot of those losses. We still ended up in the red for the benchmark S&P, as well as for semiconductors, which we might as well call them a benchmark at this point, given that they have been sort of the primary beneficiary of the rally. The beneficiary today, though, of that sell-off, you actually found it in consumer staples and you found it in REITs for one reason or another. A slight drop in yields today, down about 3 to 4 basis points across the curve.
Let's talk about some of the movements under the surface when it comes to this equity market. I threw Madison Square Garden Sports on there just for fun. We were talking about how much richer James Dolan has gotten this year. Shares finishing about 0.1% higher after the Knicks' performance last night. Also wanted to highlight J.M. Smucker closing out their best day since 2008 after their earnings report, higher by about 10%. And then your biggest weight on the S&P 500 was actually Apple. We know that they had their developers conference yesterday. That Siri update not going over too well. And you can see shares falling another 3.6% today. And let's get to our top story this hour. Chip makers under renewed volatility. Heightened swings in semis coming on the heels of an advance that put the industry stocks on track for their best year since 1999. Analysts over at Wells Fargo warning, quote, that the sugar high rally is now likely over. Meanwhile, Katy Kaminski of AlphaSimplex noting that the stability of the AI boom has left investors cautious. Romain.
All right, Katy, and it's Dr. Katy Kaminski to you, Chief Research Strategist over at AlphaSimplex Group. And we should point out a doctoral research focus on stochastic processes, stopping rules, and investment heuristics. So, Katy, explain this to somebody with just a bachelor's degree, exactly how any of that applies to what we've been seeing. In all seriousness, we talk about sort of the volatility and the rotation here. Kind of makes sense of it all. Is this kind of something that's orderly, or are we just kind of seeing people just kind of just throwing everything at the wall and figuring out where they can make money?
Well, I think today is a really interesting day because there was not substantial headline news that would have justified such a large movement in the markets. But I also want to point out that you see that there's that buying pressure in a scenario where you see the market down quite a bit. So I think a lot of people have been pointing this out. My read on it is this is a rotation. This is sort of diversifying portfolios that have already gone up quite a bit. So as a result, we're seeing this natural rotation in the equity markets where people are trying to reposition the concentration that they already have going into where we are right now.
Well, that's what I'm curious about, too. I mean, it's sort of natural to see this rotation, particularly given the gains that I presume a lot of people have already made off this big run up in some of these tech names. But in addition to the sort of the broader rotation, you're also seeing a rotation within tech itself, sort of people kind of looking at Nvidia and Microsoft and some of the early winners of the AI trade and realizing that there is another phase of AI and tech sort of taking hold right now. Where are you seeing that money go?
Well, I think this is a really good point. As you see this particular AI boom expand and as we sort of move farther along, it's not going to be always the same winners and losers as this trade sort of changes shape. And that's exactly what you're seeing right now, is that they're sort of shifting through which which companies are spending and are going to have those actual earnings, and where are we going to see those opportunities. So I think the market isn't really sure at this point, but given the level of gains that we've already seen in many of these companies, it's not surprising that some people would be rotating to kind of rebalance portfolios.
And Katy, I'd love to get your thoughts on the cross-asset landscape here as well. And I want to start here with oil. Oil has been really interesting lately and a little bit unintuitive, especially when you think of today's action, which is just a single day, but oil actually falling despite some pretty interesting headlines coming out of the Middle East. When you think about oil and energy markets in relation to equities, it seems like it had been energy that was really driving the trend for at least the beginning portion of the U.S.-Iran war. And now I wonder, I mean, when you take a look at the different trends, are these two asset classes even talking?
This is actually a really interesting question. And I was actually going to point this out today, because if you look at the fact that energy's down and equities are down since the beginning of the U.S.-Iran conflict, we actually had negative correlation between stocks and energy, which meant that sort of energy going up was stressful for stocks, whereas today you actually see energy going down, and you would expect that to be a respite if the U.S.-Iran conflict was driving equity behavior. To me, this suggests that those two asset classes are slightly decoupled in their narratives, with equities focusing on rotation, AI boom, with energy much more focused on inflation, the potential resolution of the U.S. Iran conflict, and that is also leaking over into bonds. So I actually think bonds and energies are behaving much more consistently together because they're playing on that inflation theme. So equities is sort of separate, which is kind of interesting.
Yeah, absolutely. That decoupling between equities and energy. But talk to us more about the relationship between energy markets and specifically treasuries, because it feels like, I mean, you take a look especially at the long end, that that also feels pretty divorced from what's going on in equities, but certainly makes sense when you think about it in relationship to energy.
So this has been sort of fun to watch in terms of treasuries. When you look at yields have generally been up, focused on inflation uncertainty. And you're seeing exactly the same sort of pattern today. As energy is down, that's suggesting that maybe inflation uncertainty could come down a little bit as well, which makes bonds rally, sort of causing yields to come down, right? So I think tomorrow is going to be very interesting, because the CPI print, even though we know that it's going to be higher, realizing a higher CPI print is going to keep people focused on that inflation uncertainty. So I think that energies and treasuries have actually been much more linked than they usually are. And that has to do completely with the potential for inflation uncertainty, particularly in the long end of the treasury curve.
Is there a sense, though, at least based on the trading activity, that people are treating this increase, this reemergence, I should say, of inflation as, I hate to use the word transitory, but as the idea that this is somewhat temporary, given the anticipation that we might get a resolution to what's going on in the Middle East and hopefully get, the Strait of Hormuz open again?
So this is a great question, because I'm seeing a wide range of perspectives on this. I know the market is really focused on, we think we're going to have a resolution, but this just keeps going on. And then there's others who are looking at, if this lasts for a lot longer, then the effect on inflation could be much more persistent. So I think if we see any indications tomorrow that there is some sort of bleed into core inflation, meaning that energy spikes is causing some sort of pass-through effects, that is going to spook the market even more. So I think if we could have resolution sooner than later, that would reduce some of those risks for the market.
And Katy, before we let you go, I mean, we've gone around the world here, talked geopolitics, talk, of course, the economic backdrop as well. When you think about the equity market, I do wonder how some of the risk events we have coming up, specifically at the end of this week, the biggest IPO ever, sort of marries into some of the themes that we've been talking about, the trends and the rotation that you're seeing across sectors, how we're setting up for that specific catalyst.
So I think this is very important, because it's going to give us information about this AI boom and how people are thinking about this. But we also have a lot of macro data that is sort of in the landscape right now as well. So we have to think about the ECB meeting, we need to think about the CPI print, and we need to couple that to see if equities continue to be segregated in their behavior from what's happening in the macro backdrop, and if they continue to kind of mostly focus on AI and sort of that rotation.
All right, Katy, really appreciate your time. That is Katy Kaminski. She is Chief Research Strategist of the AlphaSimplex Group, talking us through some of the big risk events still to come this week, starting with CPI tomorrow, Romain.
Yeah, actually, I'm really intrigued by this because I am not only just to see what that headline number says, but actually the components and whether you're going to have a market that looks past what we probably know is going to be relatively elevated and looks maybe towards some sort of resolution.
Absolutely.
All right, when we come back, we're going to talk AI. I had a chance to actually sit down with the president and CEO of FIS. It's basically the biggest financial services company you've never heard of. And they're doing a lot when it comes to basically, well, every time you swipe your card or buy something, and they see a big future here in agentic commerce. Stephanie Ferris is going to be joining us after the break. This is The Close on Bloomberg. Some of the biggest leaders in the world of tech and AI converging at the Mizuho Tech Conference in Lower Manhattan today. I caught up with Stephanie Ferris, the president and CEO of payment services provider FIS, on where AI in banking is headed, as well as the company's ambitious financial targets.
Safety and security is what banks use FIS for. Every piece of technology we run or capability we provide has a trust by design implied inside of it. But with respect to agentic, so as you decide that you want to let your agent make an agentic transaction on your behalf, we're the only provider that works on behalf of banks only, so that when that transaction comes to us, we know on behalf of your bank that it is an agent, in fact, that did that transaction, not you, even though it was authorized by you. And then the bank knows that it's an agentic transaction, and so to let it through or not let it through, and they can build fraud models on behalf of all of that data to make sure that the agentic transaction that you want to go through goes through.
I'm curious as to where the merchant fits in, and I just think about the recent sort of transformation that FIS has gone through, obviously selling off the remaining stake in WorldPay, buying the issuer business over at Global Payments. Is this the idea, is that kind of the future of banking and commerce is more with the issuer rather than with the merchant?
Yeah, no, it's a great question, and I wouldn't say that. We're all part of a integrated ecosystem. What I would say for FIS is we are solely focused on financial institutions and serving financial institutions. We have still great partnerships and connectivity with WorldPay, that's now Global Payments, but we've separated the businesses, and we think that makes a lot of sense because it allows us to focus on our customers, which are banks, and it allows Global Payments to focus on their customers, which are merchants. That's not to say the ecosystem doesn't work together, but it allows us to allocate capital more fully into one client segment, and it allows us to be more competitive, frankly, in what continues to be a very competitive environment.
You put out some ambitious financial targets, including for a free cash flow of $3 billion, I think, by 2028. You're confident you can still get there?
I am very confident. We think, though, well, first of all, we started out 2026 really strong. We've been outpacing our midterm expectations that we put out at our last Investor Day. But you're right, we're very, very focused on a $3 billion cash flow number, post us paying down the debt we needed to acquire the total issuing business. And we think that's really differentiated, and we have a lot of confidence around it.
So you've been at the helm of FIS for a while now. You've obviously worked your way through a couple of big M&A deals to sort of get the company to where you want it. When you look 5 years down the road, what does that business look like? Does it look like what FIS is today?
I think it does. I think we're focused on our financial institution client base, big and small. I think our job is to help banks continue to grow, run, and protect their business. So as you think about where we are in 3 to 5 years, it's making sure we have the products and services and technology that they need to continue to grow their business. And so I don't see us doing a major strategic transformative deal, much like we've taken businesses apart and put them together. We obviously look at different opportunities, but I think we're in a really good spot with where we are right now.
And that was my conversation with Stephanie Ferris, the president and CEO at FIS. She was speaking down at the Mizuho Tech Conference taking place here in Manhattan. When we come back, we're going to have another key interview that actually occurred while we were down there. One of the hottest stocks out there right now is Lumentum. I had a chance to catch up with Michal Hurlston, the president and CEO over at Lumentum. He had a lot to say, primarily about this big shortage going on in a key type of laser that most of these chip makers need to actually continue this AI build out. it actually benefits his company in a big way. He talked about that, his relationship with Nvidia, and whether he would be looking to bring on any new clients. That conversation coming up after the break, right here on Bloomberg. A lot of talk about AI, a lot of talk about tech at one of the industry's gatherings here in Manhattan, the Mizuho Tech Conference. One of the key players in that is the Nvidia-backed optoelectronics supplier Lumentum. I had a chance to catch up with the CEO, and we talked about something called indium phosphide. You might not have heard of it, but it is a key ingredient that goes into one of the key type of optical chips out there, lasers, I should say, that are needed for this AI revolution. Michael Hurlston, he's the CEO of Lumentum, and he actually controls that entire vertical stack right now. Here's what he had to say about the situation.
In order to connect all of this stuff, to connect memory, to connect the GPUs, to connect the TPUs together, you need some backbone to make that happen. And because of the speeds and the bandwidths that are occurring in the data center, the predominant means to connect things is becoming more and more optical, right? Because nothing moves faster than light. And so what you have is connectivity now using light, using fiber optics. And what we've seen is an incredible shortfall, right? We didn't anticipate all this demand. The industry was built on the backbone of the US, building out internet connectivity. And we never imagined demand like this hitting our industry and really having to service it on a relatively short time scale.
Mm-hmm. So when we talk about this idea, and we don't have to get too into the technicals, we talk this indium phosphide and all the components, all the things that go into the components that you make. Right now, it seems like Nvidia has found a way to snatch all that up, as you would think, given they are the 800-pound gorilla in the room. But what about the other customers out there, or potential customers, I should say, whether it's the Amazons, the Metas, et cetera? I mean, how much of a runway can you give them to know when, and more importantly, how much supply they're actually going to get?
Yeah, look, your question is absolutely on point. Nvidia made a very smart strategic move to work with us and our largest competitor and basically corner the market on indium phosphide. Indium phosphide is a specific material that you need to make these lasers, and lasers are what transmit the light ultimately over a fiber optic cable. So they did that, and that's left very little room for the rest of the ecosystem to operate. To build an indium phosphide fab, it's the same as some of the technology you covered. The semiconductor industry are coming out of these wafer fabs. We have these very small specialized indium phosphide fabs. And for us to put more capacity online takes 3 years, right? So it's a really long lead time that we need to respond to. So for the rest of the ecosystem, we're going to have to move relatively quickly to make sure that they're enabled.
You are building here in the U.S. How long is that going to take?
Yeah, so what we did in the United States, we have 2 fabs, one in San Jose, one in California, one in North Carolina. We just acquired the one in North Carolina. The one in San Jose is running, so it'd be the initial phase of our products for Nvidia. The North Carolina fab is going to take us 2 years to get it online.
So what does that do for potential customers? Do they just go elsewhere? Or do you think they're going to wait around for Lumentum for a couple of years? I know there's not really a whole lot of alternatives, but they're not going to just sit by idly, are they?
Yeah, I mean, it's a problem. So I think you're right, Romaine. We're trying to work out 2 things. One, we do want to enable the rest of the ecosystem. So we've had a lot more inquiries since signing that Nvidia deal from the rest of the ecosystem, and we're fundamentally interested in making sure that the industry is whole as it possibly can be. The challenge is trying to squeeze them in under the Nvidia envelope. And to your point, if they can't get the capacity, it's not like they can go elsewhere. Right? We're really the only game in town, so it pushes out their roadmap. And I think that's a deterrent to the industry. So we got to try to figure out how we can squeeze them in with the finite capacity we have.
Well, I raised that question because there's been a lot of reporting about, at least with some of the larger companies that at least have the financial means, that are starting to look for whether they can maybe manufacture some of these lasers themselves, or at least find some sort of alternative. There's also the relationship you have with Nvidia, and some concerns that, given that they are not just a customer, but an investor, that they're always going to be at the front of the line as long as this shortage persists.
Yeah, look, I mean, Nvidia did two things with us that were really important. They invested in us, which we really, really appreciated. It's sort of emblematic of the partnership, and we're working on a lot of different strategic initiatives with them. But then there was a long-term agreement that was part of it that really was the vehicle by which they put a big dent in their supply problem, but have pushed some of that supply problem now downstream to some of the folks that are their partners, right? That if you look at a Meta, a Microsoft, and Amazon, they're buying a ton of Nvidia GPUs, but they also, as you know, have their own ASICs that they build that are actually very, very important. And it's those ASICs that are at issue at the moment.
Are you not worried at all about the concentration of your revenue around one company? I mean, given the evolution of Lumentum, given the evolution of a lot of these optical companies, which of course were around during the telecom boom, and we saw a similar concentration in revenue, and we saw what happened there.
Yeah, no, the concentration does worry me. I think it's an issue, and so what we're trying to do as fast as we can is bring more capacity online. A new fab for us is, I said, a 2 or 3 year journey. But we can squeeze a lot more out of our existing fabs. And what we're trying to do is now ramp up yields, get more units per wafer out of those fabs, and hopefully create enough to give room to the rest of the ecosystem.
One more question about Nvidia, then I'll move on, I promise. I am just curious. They took a big stake in your company. They also took a big stake in Coherent. That's raised some speculation as to whether Nvidia might one day decide maybe push you two together. Has there been any discussion about that?
There hasn't. I mean, what's interesting about Coherent's a great customer of ours, so we really value them as a partner. They sort of approach things as a systems first company, components second. We're components first, systems second. So we're actually relatively complementary. They supply goods to us, we supply goods to them. We actually have a very symbiotic relationship.
When we talk about just kind of the validation of your business model, and obviously a lot of investors saw NVIDIA's investment as exactly that, I want you to kind of look ahead. I mean, over the next 5 years, and I know this technology, AI, the over broader technology ecosystem right now is moving at a rapid pace, light speed, if you will. Where are you going to fit in, Lumentum? Where is Lumentum going to fit into that 5 years from now?
Look, the most amazing thing is we're obviously in this AI super cycle, but the second headline is an optical super cycle. What you see in the data centers is more and more optics coming in, more and more fiber coming in. Yesterday, there was a deal announced between Amazon and Corning, and I think that's emblematic of the need for fiber, and fiber, ultimately lasers are what has to drive the fiber. We think that you're going to see a sort of a slow progression. If you look at the back of the racks today, there are a lot of copper, a lot of Ethernet copper. And we think that over time, that Ethernet copper is going to be replaced by fiber optics. And in that 5 year time frame that you're asking about, Romain, it's a huge opportunity for the optics industry. I think you can see a world where almost the entire backplane has moved to fiber optics.
And my conversation with Michael Hurlston, the CEO over at Lumentum. Katy?
Well, let's take a look at how markets closed on the day, because it was a turbulent day on Wall Street, especially when it comes to this equity market. The S&P 500 managed to finish well off the lows, was down by more than 2% at one point, clawing back those losses to finish 0.3% lower. The NASDAQ 100, the Philadelphia Semiconductor Index, the similar story there, but you can see that still quite a hole on this Tuesday. And then the 2 year yield falling about 4 basis points. This is The Close on Bloomberg. Well, we are just days away from the 2026 FIFA World Cup as cities across North America prepare for an influx of fans, tourism, and spending. Dan Hunt, he is the owner of FC Dallas and co-chair of the Dallas Organizing Committee for the World Cup. He sat down with Bloomberg's Julie Pyne ahead of Thursday's kickoff and the 9 matches hosted in Dallas. Let's take a listen.
If you think about Super Bowls, the average visitor comes for less than 3 days. And we have 9 Super Bowls with 9 games in Dallas, but visitors in the World Cup come for just under 10 days. And so they'll be staying in our hotels, spending at restaurants, buying gas, going to retail. So I say a huge economic boom for our area.
Talk about, now it's Dallas Stadium. We know it as AT&T Stadium, but it's certainly Dallas Stadium now. FIFA estimates that it will hold more than 90,000 people for World Cup games. If you do the math there, that's more than 845,000 for the total 9 matches. First of all, what do you think of those numbers?
I mean, the scale of this is so massive, and I don't know that we'll be in the 90s for World Cup games. We're raising the pitch at AT&T Stadium by 4 or 5 feet, which will have some seat kills associated with that. But, you know, if you even think about it, between 700 and 800,000 tickets. It's a huge number. Frankly, I need for there to be more tickets with the number of ticket requests that I've had over the last couple of months. And so it's great. In this entire tournament, there could be over 7 million tickets available.
Do you think the games in Dallas will sell out? There's been a lot of questions about sellouts, period.
Yeah, I think the games in Dallas will sell out. If you think about the matches that we have, 5 great group stage games with powerhouses like England, Croatia, Japan, Holland, Argentina with Messi. I think those games will sell out. When you get into the later games, the opponents aren't defined, right? Because those are elimination games and they're coming out of their different groups. But this is a sports city. It has a gigantic sports appetite. So I think the stadiums will be full.
I want to talk to you about the ticket prices. And again, I know those are set by FIFA. It does not go through the host committees, but there's a lot of questions about the pricing, how many were available, and the rollout. Do you think that affects attendance overall?
You know, it's hard to say. I don't think it will affect attendance. The rollout is a little bit non-traditional, how we would do it in American sports, but FIFA has their way of doing it. And you know, they've gotten some criticism over the prices, and they went back and repriced some cheaper tickets. And what I would say, you know, is there's a market demand for this, and the revenue they generate from the World Cup supports soccer globally. Their initiatives from grassroots to growing the men's game, growing the women's game, all the money associated with prize money, player money to clubs, and just in developing nations and helping the game along. And this is really their pinnacle, you know, tentpole moment that they have every 4 years. And so I know it's a delicate balance, right? You want it affordable for fans because fans make the game, but you also need to be able to have, you know, the money to help support the game for the next 4 years.
And that was Dan Hunt. He is the co-chair of the North Texas FIFA World Cup Organizing Committee, speaking with our own Julie Fine. And let's keep the conversation on the World Cup going, because our next guest is one of the original architects of modern sports commercialization. His name is George Pyne. He is the founder and the CEO of Bruin Capital. It's one of the first PE firms to focus solely on sports. George, it's great to see you again.
Good to see you, Katy. Thanks for having me.
So we're just days away from kickoff, as I said. And, you know, as Julie was talking about with Dan Hunt, there's a whole range of estimates for what the economic impact could be. And before we get into, you know, how you're invested around this, I am curious, you know, what you make of some of the figures that are coming out here.
Well, they're mind-blowing when you think about it. $13 billion of revenue generated in 39 days. The World Cup final match will draw between 1.5 billion and 1.8 billion viewers. I mean, that's Super Bowl is 130 million people. So just unbelievable. 6.5 million attendees, 3 continents, 16 cities, 104 matches. I mean, big and impactful.
Yeah, absolutely. And of course, I'm just thinking about the traffic, but that's not fun. We spoke to you about a month ago at the Milken Conference over in California, and you said that a lot of our businesses this summer will have enormous success because of the World Cup. So let's dig into that a little bit more, and how, you know, Bruin Capital has approached investing around this space, around soccer.
So we have a number of portfolio companies. We actually are going to be lighting the pitch at all the stadiums for the matches. We've got players playing on the field. We have LED signage and virtual technology. We're in and around the game in many different ways. So it drives financial results for our companies in a big way. We have a gambling tech stack called Fair Play Media. We'll have an amazing summer in terms of activity and betting. So just in a lot of different ways, it drives interest, which drives engagement.
When you look at sort of the evolution of soccer here in the U.S., and obviously a lot of it started a few decades ago with the big Women's World Cup win, and that sort of created sort of new fan engagement. What's been the trajectory up until this point, and do you think that this current World Cup, the 2026 World Cup, will also sort of be kind of one of those inflection points where we see a lot of new folks, new U.S. folks, because obviously everyone outside the U.S. has, of course, have been on this train for years.
Well, regrettably, I remember 1994. That really was the impetus for the launch of soccer. I think the Women's World Cup and Women's Euro has really propelled soccer on a global stage. And I think the World Cup here, it will mesmerize America. The whole world's going to be focused on these matches. And I think it will do a lot to drive interest and awareness of the game.
I do want to ask you about the other big sporting event, at least taking place, at least if you're in New York City, and that is, of course, the New York Knicks, which are on probably one of the more improbable runs, the first time in the finals since the late 1990s. And we were talking the other day here about sort of the increase in wealth that we've seen Jim Dolan have, but I was taking a look at just the valuation of the Knicks as a franchise, as you would expect, given how big this market is. I think it's ranked number 3 or 4, depending on who you believe. Does winning a championship, if assuming they do, does that actually have a significant increase on a team's value?
It does. In the case of the Knicks, because they're publicly traded, that stock has appreciated dramatically during this last year as a result of their performance on the court. So I would say that the Knicks' performance is driving the value of that stock today, and obviously the value of the team. And look, New York is a basketball town. New Yorkers love basketball, and it's been a long time since the New York Knicks have been where they are today. And you can just feel it in the city. It's great for sports, it's great for New Yorkers, and it's good for business.
Yeah.
And it's good for the NBA because it's driving ratings for the NBA. The finals are up 90% year over year, and the New York Knicks have a lot to do with that.
It's a big market team, biggest media market out there, more or less,
I've watched more basketball in the past 3 weeks than I probably have in my entire life. So your point is well taken there. But when it comes to valuations of teams, you know, obviously the Knicks valuation has increased. But does winningness always translate into higher valuations? Do those two lines always correspond? Because I was actually having a conversation last week in the context of football, and someone made the point to me that you think about the Cowboys, for example. I don't know football at all, so I'm sorry if I'm speaking out of turn, but I heard that they actually haven't been winning many games recently in the past few decades. But then you think about sort of the legacy, the valuation of that team, you wouldn't necessarily know it by looking at that sort of figure.
Every sport's a little bit different. I think a good example here will be the Seattle Seahawks, which will be in market, the Super Bowl champions. And my guess is that trades somewhere between $9, $10, $11 billion. So pretty good for the market of Seattle. The Knicks are different, of course, because they're public. So it doesn't always correlate to on-track or on-field performance, but there is a correlation. It certainly doesn't hurt.
Can I just piggyback on her question, though, because it does raise a good point. And, you know, you don't want to say it, but let's face it, the Cowboys have been, you know, stinkers for years.
I feel like I don't have the authority
on the
to say
field.
that.
But obviously they're very adept at marketing, very adept at keeping their name in the zeitgeist. I mean, people still call them America's team for some reason. I don't know why. I can hate on them, but you see the disconnect sometimes between winning and just having a good business model, which they clearly do.
Well, they are great business people. I remember 15, 20 years ago, their sales team came in, and I said, these guys are the best salesmen I have ever seen. So in terms of making money and monetizing a sports asset, the Dallas Cowboys are as good as anybody in the world. And they've been good on the field, haven't won a championship.
Yeah, okay. I'm still going to hate on them.
That's fair enough. But George, it's interesting, and this harkens back to our conversation that we were having at Milken. You're not necessarily investing in teams, though. That's not necessarily your sweet spot. You're more about this enablers of the game, as you were talking about when it comes to the World Cup, you know, lighting the fields rather than, you know, buying stakes in the teams themselves.
Correct. And so the higher the valuations, the higher the media rights, the more important and valuable those services are. And of course, our businesses generate cash, they have high cash flow conversion, certain liquidity, and we're able to add value. So that's more of a traditional investment where the teams are great investments as well, but a different type of investment, something that appreciates and over time, more steady.
But it's interesting, too. I mean, and teams have woken up to this idea. You have a lot of teams that now control their own media, more or less. Some have gotten into some of the ancillary businesses that you yourself is in as well. And this is kind of a selfish question. As a Bears fan, the Bears are leaving Chicago, so they'll be dead to me as soon as that happens. But they're moving to Indiana. But it does raise a lot of questions. I mean, here's a chance to build something from the ground up, meaning a new stadium. And I assume that the economics of that have to go beyond just that physical space, right? I mean, there's got to be a more more of a business ecosystem around that to make this work.
Well, the economics are just so compelling.
Yeah.
You can build a whole real estate development, and you're the landlord. I mean, just the value of that's amazing. And in the case of the Bears, they don't have certain rights in the stadium they have, so they're going to monetize the stadium better, but also the whole area around it. And it's just so compelling. It's billions of dollars. So it's kind of, in fairness, if you own the Bears, it'd be kind of hard to turn that down. And it's only 20 miles from Chicago.
Yeah, I won't be going. I understand it from a business perspective. It makes sense. And you've seen a lot of owners move in this direction that, they want to have control.
Cleveland, they're moving out of the city to an area where there's more land to build. It is compelling.
Yeah, absolutely. And something we'll be keeping an eye on. George, always appreciate it.
Thanks for having me. Good to see you. Go Knicks.
George Pyne, founder and CEO there of Bruin Capital. When we come back, we're going to set you up for what to watch over the next 24 hours. This is Bloomberg. Here's what the markets will have their eyes on over the next 24 hours. And we start with some economic data overseas in China, Katy.
Absolutely. We're going to hear from China in terms of their CPI and their PPI. So it'll be interesting to see what's going on in one of the world's largest economies, Romaine.
Yeah, and I do just want to point out, before we come back to the world's largest economy, there's two interesting earnings reports. We get Chewy before the bell, and then, of course, Oracle after the bell. And obviously, everybody will be focused on that to see whether this sort of AI momentum continues. Cloud infrastructure sales are projected to have increased 91% in the most recent quarter.
Yeah, we'll see whether or not Oracle actually meets that bar, and of course what this stock reaction is. So keep an eye on that. That's coming after the bell tomorrow. We're going to be breaking it down here on the close, but well before we get there, 8:30 a.m. tomorrow morning, Romaine, it's the big one. It's the U.S. CPI print.
Yeah, and this is what everybody's talking about. We already know it's going to be elevated because of what we've already seen with energy and gas prices. The headline figure of 4.2%. We haven't been above 4% in a couple of years. So it's this idea that now you have inflation drifting in the wrong direction. That puts a lot of pressure on Kevin Warsh and the Fed next week.
Yeah, absolutely. A hot labor market, hot inflation as well. Big conundrum for a central bank. Speaking of central banks, also the ECB's two-day governing council meeting begins in Frankfurt.
And of course, they'll have their decision on June 11th. Full coverage right here on Bloomberg. Balance of Power is coming up next at the top of the hour.